Good afternoon. My name is Gerard Vecchio. I'm a managing director at MarshBerry, and today I'm here with Paul Thivierge, Director of Commercial Banking at BMO Harris Bank in Chicago. Paul, first of all, welcome and thank you for participating today.
Great to be here, Gerard.
Thank you. Today's discussion will focus on lending to insurance brokerage firms during a pandemic. But before we get to that topic, Paul, would you mind please providing our audience with your background and information on BMO's insurance lending practice, please?
Sure. Thanks, Gerard. So I'm a commercial banker, as you mentioned, with BMO Harris Bank. I focus exclusively on the insurance broker and agent space, as well as MGAs and MGUs. BMO has a long track record of lending into this space. As many of you may know, we're a Canadian bank, and we've basically been lending into the insurance space for over 20 years, originally up in Canada, but in the last 5 years here in the U.S. as well.
Thank you, Paul. Appreciate that introduction. So my first question revolves around what has changed in your mind when considering extending credit to insurance brokers during this current pandemic?
Sure. It's a great question. And frankly, for the most part, not much has changed. One of the reasons why we like this space as much as we do, and we continue to lend aggressively into it, is the resilience of the insurance broker and the insurance business in general. The fact that it's been tested time and time again through down cycles, the fact that there's so much granularity in a typical insurance broker's book of business, that it gives us a lot of comfort as lenders that even despite some of the unprecedented economic times we're going through, these brokers are going to be survivors, and many of them are going to actually flourish through this. I think when you ask about what's really changed, I think we're a little bit more cautious as it relates to dividend recaps is a good example where owners are potentially taking money off the table, given that there is some uncertainty in the space today.
Great. So let's talk a second about dividend recaps. Do you think that change will be a permanent one, or as the economy comes back and the credit markets improve, that perhaps we do go back to, the last 3 years prior to the pandemic, dividend recaps were just, I would say, normal course of uses of proceeds for lending?
Yeah, you know what? Honestly, they aren't off the table. We certainly recognize the fact that the demographics in this particular niche are such that you have many owners that are approaching retirement. They've been building perpetuation plans with the help of firms, frankly, like MarshBerry, and now they're at the point where they want to execute them. We are still supportive of those situations, but I think we are also just cognizant and cautious as it relates to a key owner basically leaving the business and potentially disrupting the business. So while we take a hard look at those particular situations, we certainly are still financing those situations, just not necessarily quite as aggressively as it relates to maybe the leverage level that we would potentially be putting on the agency.
Appreciate that, Paul. You mentioned before, leverage amounts and pricing. Any thoughts you can give in that regard, either, directionally, whether pricing is increased or stayed the same, and or the level of maximum leverage that you're comfortable now with versus pre-pandemic?
Yeah, it's interesting because, and I'm sure you see this yourself, valuations have remained really resilient. And I think to a great degree, that's a function of so much private equity involvement in this space. I had a chance to catch up with our sponsor finance team that's very active on the insurance side yesterday. And frankly, they shared that on their side, leverage levels are still in the 6 turns of EBITDA range. We're a little bit more conservative just on the privately held, the family-owned, if you will, agencies. We'll typically go to 4 times, but that frankly has remained consistent despite all the headlines, if you will, in the economy.
No, this has been great, Paul. Are there any other changes that you would think about highlighting to our audience as we finish up this interview?
Yeah, one of the things that we're looking at more than ever before is as it relates to retention, policy counts. Given the hardening market in P&C, you can kind of disguise some of the, some of the disruption, if you will, with the loss of policies because the PNC commissions have been increasing due to the hardening market. So I think as a banker, when I'm looking at a new opportunity, whereas 6 to 12 months ago, I probably would have just looked at the retention rate based on revenue. And, assuming it's in the 90+% range, I would have just basically passed it. I think as an owner, I'd be very cognizant of what are my policy counts looking like if I am going to market to get financing. It's just another factor that we're looking at today.
No, that's great insight, and probably something that, is not talked about enough with regard to, why revenues are going up. And, if revenues are going up 10%, but rates are up 40%, then, perhaps you need to look a little bit more deeply. So with that, Paul Thivierge, thank you, Director of Commercial Banking at BMO Harris Bank. Appreciate you very much taking the time today. Thanks.
Thanks, Gerard. Always nice to catch up with you.
Bye-bye.